Welcome to EAGTAX and our tax advent calendar, where we will be sharing tax tips and explanations in the lead up to Christmas. For day 13, we will take a look at rollover relief. The aim of this relief is to ensure businesses are not discouraged from acquiring new qualifying assets as a result of having to finance the tax cost of selling a former one. The basic provision requires that the value of the net sale proceeds are used to cover the purchase costs of the replacement asset acquired either in the year before sale or 3 years following. The effect being that the proceeds from the sale are reduced to the extent they do not create a capital gain, and this reduction is then applied to the acquisition costs of the new asset. Partial reinvestment is possible, but it will create an immediate tax charge. If the amount of sale proceeds not reinvested is higher than the original capital gain, no rollover is possible. A provisional claim can also be made if the asset has not yet been acquired. The main types of assets which attract this relief is land, buildings and fixed plant and machinery, but other asset classes do qualify. The asset sold and replacement asset do not necessarily need to be from the same class. Qualifying use of assets include those used for the purposes of an unincorporated trade. This includes furnished holiday lets, an asset used to perform an employment or duties of an office, although rent received from an employer will prevent relief, commercial occupation of woodlands, trading companies and groups, and assets held personally but let to a personal company. Rent received does not impact rollover relief here, as it does business asset disposal relief. If the asset is not used in the business throughout ownership, this will restrict the availability of the relief. And where a building has only been partially used throughout the period of ownership or a substantial part of it, relief is also restricted. This applies to the replacement assets as well. The replacement asset must be taken into use for the trade or acquisition. Where an asset is not taken into use on acquisition, relief will still be available if the delay is due to work being carried out to enhance its value and the asset is not let or used for non-trading purposes during the interim period. You do not necessarily have to acquire a new asset. Money spent on improving, extending existing premises can also qualify. If the reinvestment is in a depreciating asset, which is those with a useful life of less than 60 years, the gain is temporarily frozen rather than rolled over. The gain will then crystallise on the earlier of the sale, cessation of use in the trade, and the 10th anniversary of acquisition. This does, however, provide additional time to make a permanent rollover claim, so long as it takes place before one of the crystallisation events. The one thing to remember is that tax rules and rates change. Rollover, in effect, defers a tax charge to another year, when rates and allowances may not be so beneficial. Otherwise, this remains a helpful tool to retain and increase your investment in business assets. We hope you found this useful. Please take a look at our website for more information and contact details at eagtax.co.uk.